Ladies and gentlemen, good morning. Thank you for coming. Any of you have had to get up early or earlier than normal, thank you for your additional effort. My name is Chris Gosselin from Australian Fund Monitors, and today, along with Deloitte and JCB, we are presenting a range of views on the economy. I presume there's a range of views. I actually haven't checked up what the views are yet, so we'll wait and see. A little bit of housekeeping. Mobile phones, to save yourself embarrassment, I'd just check that they're off.
As well.
Breakfast, please grab breakfast as you need, or additional coffee. Bathroom facilities outside. We're going to have an open discussion. Jonathan Shapiro from the Financial Review is going to moderate the discussion with our three speakers. Two of the speakers in particular need really no introduction, so I won't go into a long preamble about what Saul Eslake has done over the last 20 or 30 years, except that you can't really turn television on and get any economic comment without listening or seeing Saul. Mark Burgess probably needs very little introduction also. Ex-Australian Future Fund, head of Treasury Group. Both are now on the advisory committee of JCB bonds. Probably the person who does need a bit of introduction is the character in the middle, slightly younger. I've known him, he told me before breakfast, for 20 years, which is a bit of a worry. But Charlie Jamieson is one of the partners of JCB. He actually, despite his youth and youthful looks, has considerable experience in the bond market, and along with Angus Coote, his partner, has an enviable track record over just 13 months of operation as JCB bonds, of being the best performing bond fund in the last 12 months. That's about it. I'm not going to say any more about anything else. I'll leave it to the experts. I'll leave it to Jonathan to run the moderation and run the discussion. Thank you again for coming. By the way, we aim to leave promptly or finish promptly at 9 o'clock. So for those of you that need to get back to the office, you'll be able to do so. Jonathan, thank you.
Thanks a lot, Chris. Good morning, everyone. Thanks for joining us. It is a great privilege again to host the panel with what I believe to be some of the finest minds here in finance and economics. And the good thing about this panel is it's quite a diverse panel. You've got an investor and someone that's invested and traded in the bond markets. You've got an economist that's studied economies, and you've got an asset allocator investor that's had to take a very helicopter view of the world and invest and allocate billions of dollars. So has to think as well in a very big picture frame. I thought, now this is the second time we did this panel in October in Melbourne, and just looking back at it, it turned out to be quite fascinatingly important and relevant discussion. And I think anyone in that room that listened carefully to what some of the points raised by these gentlemen would have actually been very well placed to foresee what came. And then just kind of to set the scene, since that discussion in October, and I guess some of the main takeaways from that was looking at the bond market and what it was telling us about the economy and perhaps the equity market. And the bond market in two facets, interest rate markets and credit markets. And both of them were flashing warning signs, which the equity market at the time didn't seem to be taking very seriously. And I think Mark made the point, particularly around credit markets, is that a lot of what credit markets were telling us was that there was, in certain sectors, there was abundant supply, and that was quite devastating for certain industries. And that's now we've come to appreciate even more that this is what's happened in energy and commodities, and it could be a long, slow grind for these sectors to recover. A quick snapshot. So since October, the Australian bond rate, which people keep saying won't go lower, continues to go lower, was at 2.7% in October. It's now 2.4%. The US Treasury rate, 10-year rate's gone from 2% to 1.7%. And in the context, both those rates have declined as the Fed has hiked for the first time in almost a decade. The iTraxx Australia Credit Index has gone from 123 basis points to 154. So investors at the margin are getting more apprehensive about credit risk. The ASX S&P 500 has fallen 7%. The S&P 500 by about 6%. Commodity index, the Thomson Reuters Commodity Index, has fallen about 20%. So all those moves that preempted October have continued, I guess, and accelerated, which sets a very fascinating backdrop for today's discussion. I thought I would kick it off by revisiting some of the comments made in October about should we have been worried about what the bond market was telling us. Interest rates were falling, they were low, the equity market didn't seem to be paying too much attention to us. And I guess, Mark, maybe I'll start with you and ask you what they're telling us now. Should we be worried? And how does that reconcile with fundamentals and sentiment?
The question I was asked in October was, what's smarter, the bond market or the equity market? I'm an equity guy by background, so it's tempting to say the equities, but I did study this many years ago, and the bond market, the corporate bond market over 200-year history, often smells the problems a bit earlier. They're a bit more sensitive to credit, a bit more sensitive to the environment. And what the market was telling us back in October, and to some extent still is that we live in a deflationary environment. That's obvious. Everyone's now talking about it. But the market, deflation environment, you have to think through. I was thinking about the people in this room. I had to present the other day in Melbourne, and half the room were people in their 70s or 80s, maybe. They're quite old. The other were professional people in our industry. And to get them on side, I said to the half in the room, who was here during the inflationary period? And half of them got excited because they were remembering the inflationary period. And who was here post the early 1980s? And what we've seen since the early 1980s is 30 years of declining interest rates. And that's an unusually long trend in anything. And it's been a very powerful force for everything that we do. But the other thing that we saw over that 30-year period is that usually recessions come because of inflation. Usually recessions come and you get a bit of inflation, the central banks raise rates, you get a correction, and the world acts in an inflationary way. What we're dealing with now is a deflationary world, which is completely different. What happens is with deflation and excess supply, the supply eats at you like a cancer. It just sort of appears and corrodes the industry. And what the bond market felt last year was that there's clearly an excess supply. So as an investor, in any asset you look at, think about supply as your number one issue because that's what will corrode the market. And we're seeing that potentially in some areas of real estate here in Australia, but we're clearly seeing it in a whole bunch of other areas. So the answer is that the bonds saw it early. I think there's still excess supply. I think there is workouts on the way, but it's not time yet in many industries. But the other question that the markets you're obviously fearful of is that supposing this gets out of hand, how many tools are there left in the toolbox? The Economist has got that as the cover this week, as you know. We should never talk about a cover, but there's no question that we're now fearful about that changed relationship. So that was the issue that the bond market was flagging to us. What I think a lot of people aren't thinking through is that excess supply recessions are completely different. And they're completely different because you don't get an apparent crisis. It just eats at you. And the problem with that is that politicians don't respond. And this is why here in Australia, we've probably got excess supply going on a whole bunch of places, but there's no political will because there's no apparent crisis. And that is completely different to what we've been used to for the last 30 years. And the bond market smelt that and has been trying to come to grips with that as a number of asset classes. So long answer to the question, but that's what's been going on in the last 6 to 12
Charlie, I wondered if you had any thoughts on this question.
Yeah, look, I think that's all absolutely right. But I guess since then, we've gone through a fairly turbulent time in markets. We've had to deal with the first rate hike from the Federal Reserve. I guess we've written about that pretty extensively. If you've followed, kind of our monthly commentaries on the markets or been at presentations that we've given, and we were, cautious around that and around the Federal Reserve's ability to deliver on what had been discussed, and the way that it might destabilise markets and have second and third derivative implications. And so I guess that's kind of played out in fast forward over 2016 so far. I guess it was a bit lonely talking about, liking duration assets in the fourth quarter last year. A lot of people thought we were kind of crazy. But if you go back and look at cycles, certainly when central banks start to embark on a hiking cycle, the longer dated parts of the bond curve tend to do quite well. Certainly they don't sell off any further. And we've experienced a pretty powerful rally much of it which has been led by the long end and under some of these deflationary concerns. Interestingly, if we think back to the 2005-2006 Federal Reserve hiking cycle, they hiked 12 times in 16 months, and the long end rallied about 80 basis points initially as they started hiking. So it wasn't a surprise to us necessarily, but I think we're at a very interesting juncture in markets now. We know that there are a lot of headwinds that we have to face. They're all quite well known and have been discussed at length, some of which we're just not going to be able to work out what the real implications of are until we kind of pass through the ring of fire with terms of looking at restructuring and refinancing some oil debt, which we know comes up at the end of the year, and certainly that can have large impacts as it feeds through into US and European banking. We've seen the way that the correlations between oil and US and European bank stocks has picked up very aggressively since oil's been below $35. And there's these things are all known, but I guess we now live in a world where, after flirting and being somewhat dismissive of negative interest rates initially under the ECB's move negative, the shot across the bow from the Bank of Japan has really got markets talking and thinking through. Certainly this is a very powerful global trend. We now have negative rates in Europe, in Japan, in Switzerland, in Sweden, and Denmark, all very developed economies, and talking about potentially going a lot further negative. And we need to think through discount rate implications. Clearly, it makes Australian bonds seem very attractive on a global basis. It can put a lot of upward pressure on our currency if we get a lot of bond buying. All those buyers need to find Australian dollars to settle those transactions, and we're seeing that in the Aussie. That's probably fairly elevated. Given the amount of deleveraging that's been going on through the marketplace, we'd normally notice a decline in the currency, and that hasn't been apparent this time around. And it can certainly have implications for the RBA, and we can get into that.
So it's be a good time to bring you in. People are in the discussions around markets, but I'm interested in your view on the underlying global economy and then maybe the Australian economy and how that reconciles with quite a maybe negative, maybe not negative, but a kind of a low growth hat that the bond market's lens that the bond market is looking at the global economy. Interested in how you see the global economy and then Australia as well in that context.
I guess the simplest place to start, Jonathan, is with the observation that for 4 or 5 years, growth in the world economy has been noticeably below trend. And there's a variety of theories as to why that might be so, the most plausible of which is that there's an awful lot of history which demonstrates that recessions that follow financial crises and or housing busts are much deeper than the garden variety type of recessions that are caused by a period of high interest rates in response to inflation, and that the recoveries from those deep recessions are also much more protracted and drawn out. And the post-2010 episode fits those facts. Having said that, what I'm finding increasingly interesting is that in the 4 largest advanced economies, that is the US, Japan, Germany and the UK, where GDP growth has been below trend for an extended period of time, we nonetheless have what the textbooks would call full employment. In 3 of them, the unemployment rate is around 5%. It's a little higher than that in Germany, a little below that in the US officially, and it's 3 point something in Japan. All of those countries would consider that full employment. So how do we get to full employment? How did we have, as someone that I read yesterday said, the 3rd largest fall in the OECD area unemployment rate over a 3-year period since the end of the Second World War? The 3rd largest fall in unemployment over a 3-year period with below trend growth. Well, there's, I guess, a couple of explanations for that. One is that we could be mismeasuring growth. And that's plausible because we know that more growth than historically has been the case is in services, and that's very hard to measure. We know that more of what people spend is spent in ways that are hard to capture with traditional statistical procedures because it's done over the internet or it involves trade. So it's possible that we could be mismeasuring growth. That's a lot harder to measure than it is to count the number of people who are working, which we're not doing that perfectly either, but we do it better. So we could actually be mismeasuring growth. Second possibility is that the trend rate of growth has actually fallen. that what the world economy is capable of producing is growing at a slower rate than it used to be. And there's some evidence for that, because history tells you that deep recessions usually do have adverse consequences for long-run potential growth. Secondly, because of population ageing. The population's growing more slowly, and as it's ageing, a smaller percentage of that population is working. And that's even true in countries that have been big contributors to global labour supply over the last 20 years, like China. So it could be that for demographic reasons, potential growth is slowing. And in that sense, the criticism that's sometimes made of central banks that, what they've done hasn't worked and they need to try something dramatically different is, in my view, to some extent misplaced, because central banks have actually got, in the 4 biggest advanced economies after the worst recession since the end of the Second World War, have actually managed to, quote, restore full employment. And in the US, CPI inflation over the past year is 2.2%. Now, I'll grant you, the consumption expenditure deflator, which the Fed says it targets, is 1.4. But if consumer spending is being mismeasured in the national accounts, then that may be a mismeasure as well. So if you had sort of kind of said, what do you expect a central bank to do? Well, the law in the US says we want full employment and we want inflation of about 2%. Well, the Fed's got there. And we are now starting to see in those countries where you are at full employment, wage inflation is starting to creep up. Most obviously in the US, but you can see it in the UK, you can see it a little bit in Germany, although their wages figures aren't very good. You can't yet see it in Japan. And so my sense is that while the bond market's obviously telling us the things that have been canvassed, they may not be completely right about that. We're getting massive deflation of commodity prices, and as Mark correctly says, that's because of excess supply. In my view, that means a very different story from when commodity prices fall a lot because of deficient demand. There are some things happening in the technology space that are putting downward pressure on a range of other prices, but that's a kind of late 19th century good deflation rather than sort of really scary deflation. And the other big problem I think the world economy has is that central banks have not only had to deal with the legacy of the financial crisis and the burst bubbles and so on, but they've had to do that in the face of fiscal policy that's been pushing in the wrong direction. We have also been through the largest fiscal tightening as measured by the cyclically adjusted budget balance in the OECD area since the early 1980s. And yet we still managed in the 4 biggest economies to get back to close to something like full employment. So some of those who say, what would we do if we face another recession globally, which is not impossible, they're sort of thinking, well, what more could central banks do about that? When central banks are almost at the end of the tools that are at their disposal. And we'll probably talk a bit more about negative interest rates, but I would say the recent experience of that hasn't turned out so well. I mean, people have always thought that there was a zero lower bound for interest rates. We now know that there isn't, but it's only been recently people have started to think about, well, what does negative interest rates actually mean for the banking system? And that's a worry that I don't think people had thought about. It's in effect a tax on banks. And from Japan's point of view, clearly one of the purposes in their situation of going to negative interest rates was to push the yen down. Well, that hasn't worked so well either, has it? So, I think central banks are going to be wary about going further down a path that hasn't turned out so well. And there's a lot of interesting implications for what policymakers could do that come out of all of that.
Saul, I might come back to you in a little while on Australia and our unemployment puzzle and our specific, but I thought, seeing as you touched on negative interest rates, I thought maybe I'd bring Mark and Charlie into this. It's quite a mind-bogglingly fascinating but slightly disturbing reality, isn't it, that bond rates are now negative? And I guess, how do you sell your asset class when 60% of the outstanding securities are cost you money to own? So just loved your musings on negative interest rates.
Obviously, in Europe we have a tremendous amount of sovereign debt which is now at negative interest rates, and I guess the concern is that under a deflationary scenario, you're still more than happy to accept a negative interest rate if you have far more purchasing power on that money at a later date. And I think maybe Mark can comment. The Future Fund have just gone back into buying long-dated government bonds to hedge out some of that deflation risk. There's obviously real concern there that the environment that we face certainly has that as a possible scenario. I guess, from our point of view, sitting in Australia, we still have 200 basis points of carry available at the RBA's disposal. We were talking last night about, with the changing of guard from Stevens down, maybe that's a nice gift to offer the next governor, that you do have a lot more ammunition in your rifle clip than any of your global compatriots. There is room to adjust rates lower should they be required, and we can get to some of the reasoning and some of the triggers how we might get there. But from our point of view, as I said earlier, if you're managing money offshore and you're faced with negative interest rates in your domestic markets, Australia stands out as an absolute beacon of investment opportunity, given that we still have considerable yield on offer in the global marketplace. And you are seeing that, people are coming in to consume. And, we very famously saw Angus, my business partner, as a central bank salesman, and did some of the first ever central bank trades. There were people coming in to buy Australian assets. I think when he started, there were 5 central banks buying Australian government bonds. Now there's over 100. And for very good reason. You saw the currency get to, $1.10 after the GFC. There was a wave of money coming to invest capital in Australia. And as we said, all of those buyers need to settle those transactions by buying Australian dollars. We're certainly going through that in a lesser capacity at the moment, but the buy flows that we hear from the market are very powerful. And you are seeing, the Australian dollar starting to behave in an entirely new way, given what we would expect at this stage of the cycle and given some of the deleveraging pressures that are going on through equity markets and the like. So I think it's very important to think through the flow implication of that. I guess, negative rates, are a very difficult thing to deal with. It's something that we've always considered zero to be the boundary valuation condition, and we're seeing offshore that is absolutely not the case. We've had, the Swiss National Bank talking about -75 is not low enough, and they can potentially go substantially further. We had the Riksbank cut 15 basis points to -50 week before last, and then we've obviously had a lot more commentary around the ECB going deeper negative. So it really is mind-melting for all investors, I think, but also you run into the logistical implications of running an economy in negative interest rates, where I believe there's one Swiss canton now that would like you to delay paying your taxes as long as possible. They don't want the money in the bank earning a negative rate of return. And so you get this topsy-turvy world where trade financing and trade flow would be hugely impacted. And I think that's what Saul was illustrating. There are limitations around the effectiveness of the policy, but there's also a ton of spread implications for the finance industry. I mean, Mark, I think, thinks that finance is probably going through a very powerful recession in our industry in particular, and a lot of those spread-based businesses are severely challenged under this scenario, and probably will be for some time. And I think we were talking last night about, be wary of the complex product as the financial industry tries to find a way to retain margin by making things much more complex than they should be. And it's definitely a danger to watch out for. Maybe you can comment.
You stole all my talking points.
Sorry, mate, yeah.
But there's no question that financial services is now in a severe recession, I would have thought globally. In a way, it's long overdue, and we're all in financial services, so I don't say this with any sort of pride. But there was a lot of debate post the GFC that financial services became too big a part of the economy. If you think about financial services, it's my point about falling rates. Financial services is a spread business, but it's also benefited from the revaluation process that happens when discount rates decline. And so we've constantly had capital growth. And in fact, one of the biggest decisions that funds like the Future Fund, I can't talk on their behalf now, but had to face in 2012 or 2013, before buying an airport or an infrastructure asset, you had to make the very big decision that the discount rate was no longer 10 or 11, but it was going to be 7 or 8 in perpetuity or less. As I used to say to the guys internally, it doesn't matter what the airport is, we've got to make that decision first, because otherwise we'll never get the asset. That was a really brave call, and some people did it, some people didn't. And if you didn't think mentally at a lower level, you missed those assets. And I go to a conference with the major CFOs in Europe every year. I've been there, I'm going again this year. 4 years ago, their cost of capital was all over the shop. It was 9, 10, 12%. No wonder they were saying no to projects, because they just didn't understand the world had changed. Now, since that time, most of these assets are now pricing that in. And so, but when you get that repricing, you get a dramatic, 20, 30%. There isn't a real estate person, I said this in October, a real estate or infrastructure person who doesn't think they're a great investor. The fact is it was the wind behind them, largely. I'm not saying they're not good investors, but that wind has now died. In fact, it's quite correctly priced in. And if it goes any lower, which is what people are now worried about, it's suggesting that the earnings side of your valuations are going to have a problem, that there's something systemic in the system. And so what's going on here is that the market's trying to come to grips with this. And no wonder we're getting volatility, because it's the end of a 30-year trend of falling rates. We don't want to be too bearish about it, but it does mean that banks, anyone in a spread business, insurance, are under pressure. Employment is going to halve if it hasn't already. It's going to be tough. The second thing is that for investors, you need to be careful not to overstretch, because in this sort of corrective process in financial services, as Charlie said, there's a temptation to come up with weird and wonderful products to keep the margins up. Of course, they'll have hidden risks and things inside them. So it's going to be a tough period for investors, and the most important thing, I think, is working with them to get them through the period so that they don't over-egg, and then take the opportunities. I want to be optimistic about this. There will be opportunities. India will have great demographics. The US is a well-run country. Eventually, you'll be able to buy some of these commodities at distressed levels. There'll be opportunities for smart advice, but it just won't be a constant wind behind your back of falling rates, constantly repricing assets, which is what, in essence, we've had for the last 30 years. Give or take a few corrections, but that's been a real factor that's probably dictated most of our careers and certainly most of our clients' portfolios. The very best person to be was a wealthy person 25, 30 years ago who was maximum long duration, or a wealthy person even 5, 6 years ago who went maximum long duration. For future savers, it's just going to be a tough haul to get single-digit returns, but with good advice, they can probably get better than that. I think that's the theme. Yeah.
Well, Mark, I can't resist. I'm going to go slightly off-piece, but I can't resist bringing in housing because it's been a bit of an obsession with our paper. But that's been a long duration asset that a lot of Australians have done very well out of getting into housing for a long duration. How do you kind of reconcile that flavour of duration against a government bond or an infrastructure asset?
To two sides to housing, I'll be very brief. Housing will suffer like a lot of industries where excess supply will cause the correction, not rising rates. So watch for excess supply. Does that make sense? So previous house corrections have been because the central bank raises rates, you get the rollover, the whole thing collapses. This time it'll be excess supply will cause a correction. It'll be a slow burn correction to begin with, and then at some point there'll be people bailing out of it. That's number one. Number two, and I'm not an expert, and Saul's got strong views on this, but negative gearing is a capital gain exercise. And if you think about what causes capital gains in housing, it's demographics, which Australia's quite strong at, but it really is also falling rates causes most of the capital gain. If the falling rates thing's coming to an end, people are going to sit on all of this stuff without a lot of capital gain, and eventually if you've got 3 or 4 of these things, you want to sell one of them, and then you'll get this supply aspect, and then the thing will start to correct. But that might take a number of years to correct. So I'm kind of bearish on housing. For my kids, it's fantastic because they can't afford it now, but they're late teens, early 20s. I'm not sure it's going to correct soon enough for them. Otherwise, I'm going to have to stump up a deposit, right? But we're in that window. I think we're in the window where we might get a decent correction and actually make it affordable for young people to buy a house. And that, in the long run, is a good thing. But we're in that sort of mispriced situation, in my opinion, and so we need to see a correction. But 60 Minutes on Sunday was very definite. I've never seen a reporter with such a strong investment view. I don't know whether you saw it, but it was incredible for a reporter to be making those predictions. But it could happen over a 3 to 5 year period that you start to get quite a decent correction in housing, in my opinion.
So maybe this is a good opportunity to, I don't know if you have any views on housing, but maybe the Australian economy in general, how robust it is, and maybe try and reconcile. I know you touched on it earlier, looking at the 4 largest OECD economies and how, even though there's been low growth, we're at full employment. What's your musings on the Australian economy, our unemployment picture, our prospects, and then maybe we might explore the RBA and the dollar after?
Well, the Australian economy is making a transition from growth that for a few years was led by extraordinarily rapid increases in mining-related investment to one in which growth is led by a combination of mining exports that are at falling prices and don't employ many people, but nonetheless have accounted for more than 40% of the growth in real GDP over the last couple of years, and which is likely to continue as LNG plants come on stream. and some other and other sources of domestic and foreign related demand. And you'd have to say that that transition is working better for Australia than it is for other countries that have been in similar positions, like Canada, which has had a recession, and Brazil, which is still in one and has double-digit inflation into the bargain as well. And we sometimes lose sight of that because our own experience, our yardsticks for the last 25 years have been so favourable. So we've had, while that transition's been going on, 4 years of below-trend growth. You know, we're not Robinson Crusoe in that regard. The whole world has had below-trend growth for a while. It's possible that growth is being mismeasured in Australia as well for the same reasons that it is being internationally, and that could be one explanation for what otherwise seems this paradox between growth being below trend and yet the unemployment rate appears to have been declining, and employment growth has been much stronger than you would have expected given what GDP growth has been doing. Now, I know there are reasons to doubt the precision of the labour force data, and the ABS acknowledges that. And I doubt that employment growth has really been as strong as the numbers suggest. But the employment numbers aren't the only ones that are pointing to a tightening labour market. I mean, you've got the ANZ job advertisement series, the SEEK job advertisement series now, the Employment Department's employment series, the National Australia Bank's business survey has an employment component in it, and they are all showing an increase in employment. So they can't all be wrong, you know, even if the absolute amount is right. So why has there been stronger employment growth than you might have expected given what GDP growth has been doing? Well, I think part of the answer is that this rotation in the sources of growth is from the least labour-intensive form of economic activity known to mankind, namely mining, towards some types of economic activity that are really labour-intensive. You know, so dwelling construction employs a lot of people, tourism employs a lot of people, healthcare employs more people than any other sector in the Australian economy at the moment, and that's continuing to grow. And for the most part, these are also low productivity jobs, so they don't get paid all that well, which helps explain why wages growth has been low. It's not the only reason. It could also be that real wage growth in wages being as low as it is has encouraged employers to substitute labour for capital. Firms are reluctant to commit to big capital expenditure programs, partly because, as Mark says, they may not have brought their discount rates down sufficiently for the new reality, but also because the financial markets investors are very punishing of boards and CEOs who make bad capital expenditure decisions. You know, the reaction to BHP, for example. At the moment. So if you're seeing an increase in the demand for your product, but you're not sure how long it's going to last, the safer option is to meet the increased production by employing more people, because they're cheap and you can sack them relatively easily if it turns out to be wrong, than to undertake a big new capital expenditure program. And that might also explain why you've got weak non-mining capex at the same time as you've got rising unemployment. So, as I say, people have doubts about whether the employment numbers are as accurate as they used to be, and that's fair enough, but I don't think that undermines the overall story of where the Australian economy is doing. Now, we could be doing better if, for example, we had done more publicly funded infrastructure investment, for which Tony Abbott said he wanted to be the infrastructure Prime Minister, and during his time there, infrastructure spending went down as a share of GDP by a conspicuous margin. Glenn Stevens and others had gone as far as any central banker should in giving gratuitous advice about fiscal policy to the government, when they pointing out that interest rates are as low as they have ever been. There could, if Glenn Stevens was Malcolm Turnbull, he could have said there's never been a more exciting time to be borrowing money and spending it on public infrastructure. But nothing's happened really, except for Mike Baird has done what he's done in New South Wales, and that's one reason why New South Wales is doing better than the rest of the country, is because there actually is some public infrastructure happening here. But, as I say, we're doing okay given the headwinds we're facing and the policy mistakes that are being made by others, and I suspect that describes the picture over at least the next 18 months or so. Now, if you want me to say something about housing, I will, but you might want to move on to another topic.
We might come back to that, because it's one that everyone's always interested. Maybe, Charlie, I might bring you in here and given some of Saul's observations of the Australian economy with your bond trading hat on and your bond investing hat, so whether you're looking over in a short-term period for maybe a next interest rate move, or even longer term. How do you reconcile that kind of maybe more positive than what many people had predicted view of Australia versus with trading the market and rates?
Look, I guess it's just to take a step back and kind of set the scene for where we are and what's happened since the GFC. The GFC being the biggest debt bubble that the world's ever faced, and caused a tremendous amount of issue. In response to that, we've created a debt bubble which is actually 50% bigger in nominal terms. But most importantly, that 50% increase in the amount of debt that's been issued since the GFC has happened at essentially zero interest rates globally. Now, of course, when we talk about the global markets, there are always micro markets inside that have slightly different things going on. But in general, the debt burden now is as large as it's ever been. And so when we kind of think about the markets, I guess, we see that the markets are quite brittly balanced. They're quite finely balanced. And if you do one-off kind of shocks like trying to hike interest rates materially in the US, that can have severe consequences throughout the system as flow of funds start to move around. I guess most obviously it happens in the US dollar, where we've had tremendous amount of US dollar appreciation, which has hurt emerging economies very powerfully, given that they borrowed very heavily in US dollars coming out of the crisis, and those debt burdens are now growing nominally with the dollar appreciation, whilst their economies domestically are challenged. You get the negative feedback loop through the commodity piece. You also see it through the petrodollar piece. And then you see it turn up in S&P earnings, which 40% of which are derived offshore, and we've seen headwinds there. We're into our fourth quarter now of declining S&P earnings. So, we've always felt that, and you also get the second and third derivative implications, like China's devaluation of their currency. They haven't enjoyed, the strength of the US dollar, and that's certainly, given markets a tremendous amount to think about, and potentially has large deflationary consequence around the region. So, when we think about the Australian market, certainly, as much as we talk about 30 years of declining interest rates, everybody always wants to tell me why they have to rise materially. And as much as I understand the argument, I also see that if you do raise them, normalise them essentially, and hold them at higher levels for a sustained period, then we have a default cycle which unlocks, because people can't refinance. All this money that's been borrowed, it needs to be serviced like a mortgage. There are payments that need to be made periodically, but most importantly, it needs to be refinanced at some stage. And all these debts have differing maturities, whether it's 3-year, 5-year, 10-year, 30-year. On a rolling time frame, these large maturities come up, and they do need to be refinanced. And as I said earlier, we're going to go through that ring of fire in the energy industry, in the high yield sector in the US later this year and into 2017, and we simply don't know what the real impact of that will be. I mean, it's a little bit like subprime in 2007. Everybody said it's going to be an issue, but it can't be an issue because we know so much about it, and it's the unknown unknowns that come and get you. Well, but it was an issue, and it's not until you go through that you realise, where all the exposures are. We know what the exposures are on the bank balance sheets in the energy sector, for instance. I think Merrill's are 21 billion, JP 25, I'm not exactly, 27 at Citi, something like that. But what you don't see is the synthetic exposures and the swap books and the like, which are much harder to ascertain. And so, as we said, the correlations with those bank equities and European bank equities really accelerated as oil has sold off. And I guess we're in a world where we just produce far too much oil. It's very difficult to see how we can get a material bounce, especially at a time when there's a lot of division in OPEC and the like, and Iranian supply coming in on top of all of that. In Aussie, I guess, we've always felt that there's very, very little probability that the RBA would hike rates anytime soon. If there is movement there, it'll be to the downside. And if they do go and come off the sidelines, it won't be a 25 basis point move and done. It'll be more than that. They don't tweak interest rates. If they're going to move, they want to get bang for their buck. So you would expect at least 50 delivered in two movements of 25. And so I think when you look at bond market pricing, certainly in the front end, you need to keep that in mind, because at the moment we look like we're priced for a full cut, which we are. But in my mind, it's actually 50% priced for a 50 basis point move, should they need to come in. Now, we can get to the employment data. I've written about that a lot. In the last quarter of 2015, we had the strongest employment data in Australia in the last 10 years. We filled the SCG and the MCG month over month with new jobs. And I just don't feel like I live in that country. And there's been a lot of talk about the rebalancing of the sample rotation in the basket with that data. It's only 1,000 people in the survey, so it's quite a small sample size. And I guess, if equity markets are very challenged, the currency is is rallying and we get some statistical give back in that employment data, I think we're in a position where we know inflation is at the lower end of the targeted band, where the RBA can move. Now, that's not 100% probability kind of thing, but we're certainly on the lookout for that, and we'll monitor that very closely. The market kind of has that as a default position, and it's a premium that it's very happy to pay at the moment. I guess, as we said, Australian bonds still look very attractively priced in the global context. So as much as the bond market it doesn't move in straight lines. We do go through periods where they do pull back. Those pullbacks tend to be very shallow. I guess most famously from our own experience since we've been running the fund. I mean, I've run some very big portfolios for Merrill's over the years and traded through all kinds of cycles in London and New York, rate hikes, rate cuts, planes hitting buildings, viruses spreading uncontrollably, financial crises, European crises. They are fairly manageable. So, in the second quarter of last year, for instance, we had the largest sell-off in Australian government bonds we've had in 25 years. Very large sell-off. Inside that 25-year period, we've had 4 RBA rate hiking cycles. So to say it was a large sell-off, it was a sell-off that would be of a similar size to rate hikes, and our fund managed to navigate that down just short of 1%, and then we've started performing again. So as much as it doesn't move in straight lines, I still believe that the pressure is to lower rates here, not necessarily driven by RBA moves, but driven by global factors, and it is absolutely a global marketplace, and capital moves very quickly to take and find yield and carry an income where it can find it. And so I believe that thematic will absolutely continue. And there is, of course, the chance that you might get the slingshot effect of an RBA move later in the year if equity markets and risk markets can't find their feet. And certainly we're going through fairly volatile times at the moment. We know there's a lot of headwinds, when we look through China and we look through oil and we look through currency depreciations and the like. We've got the European migration crisis coming up. When it warms up in Europe, those people will be on the move again, very desperate. They will arrive in Europe via Greece. It'll be at a time where we're going through, Brexit discussions. So there's potentially, good flashpoints in around geopolitical events as well, which can kind of destabilise things. So for mine, I think that that market will remain very well supported. We don't think it'll probably move a tremendous amount over the year, but it will remain volatile. And it's actually, I think, as all asset classes, Mark, as an asset allocator, you'd probably agree that firstly, portfolio diversification is important, but active management to some degree is quite important at the moment because the trends, as you said, we're getting to the end of that one-way run. And it gets much more difficult from here in order to catch a clean wave all the way to the beach.
Now, one of the other interesting points we discussed last time was the role of capital flows, whether it's China, capital flows outside of China that's forcing the Chinese central bank to sell their US treasuries, sovereign funds being hit by lower oil prices, which means it's not quite fire sale, but they are liquidating assets, and that is having an impact on financial markets and bond markets, I guess, to some degree. I'd be interested, maybe starting with you, Mark, because we spoke about this last time. But what's your view on how these impacts are affecting financial markets, and do you think it will be a sustained force behind the scenes for financial assets?
Yeah, there's no doubt that there's been a lot of change. Just to explain, the sovereign wealth funds are largely commodity-based funds, as the Australian sovereign wealth fund is the future fund to some extent. I was at a conference last year for the funds, the Sovereign Wealth Forum. The commodities were already correcting, but I got a sense that they weren't yet of the mindset of having to readjust their portfolios. And that's kind of understandable because of the way these big funds think. I'm not talking about the future fund. In fact, I think the future fund, since I left, has done a great job. But these other funds are slow to move because their entire last decade has been all about where to invest new inflows. They've had more money coming at them than they know what to do with. And to switch from being a buyer to a seller actually is a kind of quite a significant change inside an organisation. They were slow to sort of think that through, but I think over the last 2 or 3 months there's been a rush to get out. And I still see sometimes in the press they go, these sovereign wealth funds in the Middle East will definitely be buying this infrastructure asset. And in some cases they will, but they won't be doing it like they did 2 or 3 years ago. There won't be an obvious, desire to buy because internally I'm sure they're going through a process of which of these assets do I need to sell. And so I think we have seen a bit of it's hard to get data that's not clear, they don't discuss it. But based on my understanding and then talking to people in the industry, there's absolutely no question they've been scrambling to raise cash to fix fiscal problems back home. And that at the margins has affected markets. I'd love to talk about China a bit longer, but I think China's got a whole bunch of other dynamics going on there. But for sovereign wealth forums, getting out, readjusting, and they've done it more slowly than you expect, but I think that's washing its way through the markets. We're probably, I don't have a guess, but we're well into that process.
Actually, maybe now is a good time to bring in China, and given a lot of policy actions from China caused, or could be, a lot of the market's nervousness at the beginning of the year could be pinned on trying to understand China's thinking around the currency and the actions it's going to take. Interested, Charlie and Saul, on China more generally, but how you think policymakers will kind of navigate perhaps the need for a lower currency, whether they try and devalue it quickly, whether they don't devalue it at all, how they manage capital outflows, where their priorities might... it seems like there's lots of moving parts which are difficult to understand, so interested in your perspectives.
Well, China's economy is obviously slowing. There's no dispute about that, as it had to, because it didn't make sense for China's economy to continue growing at 10% per annum. You know, if it had done, you can sort of do the maths on the back of an envelope by 2035. If China's economy had continued growing at 10 and the rest of the world at 3 or thereabouts, China would have been 30% of the world economy, or 35% of the world economy, at a time when it had less than 25% of the world's population. It just sort of didn't make sense. So China's economy is slowing, the mix of growth is changing away from commodity-intensive manufacturing and investment and construction towards consumption and services, which are, as I've said before, harder to measure. And we know, obviously, that Chinese growth numbers are less reliable than those in many other countries anyway, so that sort of compounds that. But what I think is also happening is that markets have lost what I always thought was an almost naive faith in the ability of the Chinese regime to deliver on whatever they said they had promised. You know, no investor, very few people would look at a Western government that said, we are going to do X, and assume, well, then X is the most likely outcome. We're much more cynical about that. Yet for 15, 20 years, supposedly hard-nosed, cynical investors have worked on the assumption that if a bunch of communist dictators say that the result will be this, then that's what it will be, and that faith has been shattered. So there is now a much more sceptical, questioning, cynical attitude to the promises made by Chinese authorities about where the stock market will bottom or where the currency will go. And in that context, it's kind of surprising the shock horror language that's used to describe what's happened to China's currency. I mean, if you put it on a graph with index them all to 100, put the yuan, put the Australian dollar, put the ruble and the real, you struggle to see how the Chinese yuan has moved at all. Yet people, the way the language people use, you'd think they devalued the currency by 25%. What's not helped is very poor communication around what they are doing and why they are doing it. So if you think about what happened in August last year when the headlines screamed that the Chinese were trying to engineer a maxi devaluation of their currency, all I think they were really doing was seeking to move to a slightly more market-based way of setting the currency at the opening of each trading day, rather than having a ring around to the 5 state banks saying, what do you think the midpoint of the range should be? A bit like the way I suppose they used to set LIBOR in London. Now they said that it will be wherever it finished the day before, and because it had finished at the low end of the range 2 days before, that automatically meant that it was going to go down. But this was sort of interpreted as a major change in the strategy rather than the tactics. What I think the Chinese were also trying to do, and remember this was ahead of what was still widely expected to be the first rate hike by the Fed in September, was to disconnect the yuan from the US dollar that was continuing to go up. And so the yuan had come down, I don't know, maybe about 4% against the US dollar over the previous 18 months, but it was still more than 20% higher in trade-weighted terms. And the Chinese were probably thinking themselves, well, the Fed's going to hike eventually, the US dollar will go up. If we don't do something, then we're going to get dragged up with the US dollar at a time when the won and the yen and the Malaysian ringgit and all these other currencies around us are going southward. So that was a sensible sort of thing to do, but they botched the communication around it. Now the risk they've set up for themselves, of course, is of accelerating capital outflow. Because if you're sitting there in China and you think that the Chinese might be about to devalue the currency quickly or by any amount, then you want to get your currency out before that happens, either to avoid a loss or make a profit. So you've had an acceleration of capital outflows, and that's reflected in the fact that the Chinese reserves have fallen by $800 billion over the last, whatever it is, 15 months or so. And that then challenges the assumption, which lots of people, me included, have made in the past, that even though China's got lots of debt, most of it's owed by state-owned enterprises to state-owned banks, so they're opposing entries on the same ultimate parent company balance sheet. If it really hits the fan, you can just write it off, and then you have to recapitalise the banks, but hey, there's $4 trillion sitting there that you can draw on. That assumption then gets challenged if all of a sudden there's actually not $4 trillion worth of reserves, but there's $2 because they've spent $2 trying to defend the currency. So the Chinese, through authorities, through poor communication and that sort of thing, I think have made the challenges facing them more difficult. Having said all of that, China's a world away from where Thailand, Malaysia, Philippines, all those countries were 97, 98, and drawing parallels between that experience and what China may have to contend with is, I think, grossly exaggerating the risks.
We often joke amongst ourselves that $4 trillion has been spent about 5 times over fixing China's problems. So certainly looks like they'll be leaning on it more in the future. But I guess the thing to note about the currency depreciation is it's an entirely managed series. And so we've written again about this at length, and I guess Angus is in a wonderful position to comment. Having done a lot of the first ever bond trades for a lot of these Asian central banks, we work very hard to maintain our relationships with them, and we definitely see it as a large part of our competitive advantage, and we have it on good authority that will be at least a 10% depreciation. We're about 5.5% of the way into that at the moment. We were quite surprised to see that the market didn't really pay attention to this over November and December. If you go back and look at a chart of the yuan and then overlay it with an S&P kind of chart, you'll see the huge disconnect in August where essentially the Chinese depreciation there roiled the September Federal Reserve rate hike. They got the yips and they decided to pass after a bout of intense volatility. But through November and December, they were accelerating again under the assumption that the Fed would go in December, and then we finally did go. And then that acceleration in January, people really woke up to the fact that this is quite destabilising, and equity markets corrected very powerfully. We certainly expect that to continue, and as we said, it's a headwind that we're just going to have to sail into over 2016. I guess, as we look at the fundamentals, we spend a lot of time thinking about the sentiment around those fundamentals. They do get to extreme quite often, in markets at the moment. I guess 2 weeks ago, we got to that bearish extreme where we were, looking at, powerful sell-offs and, where are we going to find some footing. And we finally got some comfort, around the markets from various central bankers. It actually started with the ECB. Yellen was probably more neutral than she'd been previously. We had some, chat at OPEC about freezing supply and the like, and equity markets have been able to find their feet, and we had that, recovery rally, which was really important to generate and take some of that, vicious, oversold nature out of markets. And again, we wrote to investors last Friday saying that we think we're at somewhat of an inflection point again. That bounce looked to be fairly complete, and I guess we've been rolling over in the last 48 hours again. The China thing is going to continue to make headlines. It will be very dependent upon what Fed policy looks like and the market's expectation of Fed policy and dollar strength. I guess if we look at markets there, as much as people are still talking about multiple rate hikes, and a lot of the investment banks have that in their forecasts. They've kind of come from 4 down to 3, maybe only 2. We know that we're going into the presidential election cycle. The Fed don't often operate in that window, so the second half of the year looks out. If the volatility calms down, potentially we could see one more, although Fed fund futures pricing is actually pricing in no further move from the Federal Reserve. And so under that scenario, we would expect the dollar to lose some of its luster, and therefore potentially less Chinese depreciation to need to go on as a result. So there are a lot of moving pieces to how we're going to kind of navigate and play that space. And it's a very fluid situation, changing all the time depending on what's happening in other parts of the market. It always amazes me as a trader how the market can just be fixated on a particular set of things that are happening at the moment. Obviously, it's oil will drive everything, but it was only 6 months ago it was Greece, and then we changed geopolitics, and then we get a slight blip of inflation, and we focus on that for a period, and then we just change gears and forget that thematic altogether and focus entirely on something else. And kind of need to load up your correlation
Like
model.
journalists.
Just load up your correlation model and just say, okay, everything off oil for 6 weeks, and we really do trade like that a lot of the time. I continue to think that there is challenges that we're going to be presented with from China, that we're expecting more depreciation. There's a bunch of hedge fund guys running around saying it could be up to 40%. We think that's very extreme, and we don't see anything like that. So just want to dampen everybody's expectation there. Not to present too dire a picture, a lot of these challenges which we know we'll face will present wonderful opportunity for investors, later in the year, where valuations will be much more attractive, and I think patience to some degree will be very well rewarded. And we run a very conservative fund, and we'll continue to do that. But I think that there are challenges from China for a while yet.
I thought I would open up for questions if anyone's got any. Sure.
I just wanted to ask you, Charlie, what you think the implications are in terms of valuing emerging markets.
Emerging markets, well, look, obviously they've been very strained for quite a period. Again, they would enjoy a substantially lower US dollar. That really is, when we think of stimulus and we're kind of playing in this 2 versus 1 scenario where we're getting stimulus from the Bank of Japan, we're getting stimulus from the ECB, but we're having it taken away from the Federal Reserve. You've got to remember that we need a lower US dollar to rebalance markets, and stimulus from the Bank of Japan and the ECB only foster a stronger US dollar. So I think the markets are really demanding US dollar-based stimulus. If we think about how do we get to that place, certainly over historically since the crisis, when the markets have dropped around 20%, the Fed have come in with another stimulus program. So when we finished QE1, the S&P dropped from 1050 down to about 850, and we went straight into QE2. When QE2 ended, the S&P dropped 19%, and we launched straight into Operation Twist. Operation Twist, they decided they would taper early. We had the taper tantrum very famously, and they immediately extended it by 6 months. So if we think about markets in that way, and if we kind of had this 1700 area and the S&P as our kind of floor to where we would think the markets could go in the near term, that also lines up with if we correlate credit widening and spread deterioration, where equity markets would find their floor, given what we know about the deterioration in corporate credit quality as the market views it. So I guess that's the target for us in time, and emerging markets will benefit, if we do get to that place and the Fed put their arms around the market in some way, shape or form. I don't think it's straight into a QE4 program or anything like that, but potentially another twist. Certainly the realisation that rate hikes for now are absolutely off the table, and we're facing a number of scenarios where the Fed commentary is already neutralised to some degree after being quite hawkish, as it needed to be coming out of the rate hike. So I think that would benefit emerging markets, and we're already starting to see, I guess maybe we've had a mini turn in the commodity cycle to some degree. There's been a bit more support there, and that all kind of plays into the way we think about the market construct. So I think hopefully they can do a bit better looking forward.
Mark, it'd be great to just hear your views on where somebody should be sitting from an asset allocation point of view, or how you're thinking about asset allocation at the moment, and then I guess what are the key things that you're looking for over the next couple of years in terms of what would actually shift that?
It's a good question, because it's a good question, not because I'm going to answer it. I'll give a bad answer to a good question probably, but it's a good question because the theme that I would leave you with is that you need a broad strategy to get through this volatility. It's clear. We've had a great 30 years, been brilliant, but we've got 4 or 5 major changes taking place all at the same time, which is not uncommon, which is unusual. We're not used to it. One is that China is in adjustment. I'd love to talk about China, but they've known. I attended a policy session in 2013. It was all in Chinese. I was surprised to be invited, me and a couple of foreign guys, but all internal, on how to get consumption to grow. They've been at it for a few years, and they know they need to do it. They also know that they have, I think China has a fantastic competitive advantage, and that's its entrepreneurialism. They're unbelievably entrepreneurial. I'm generalising, but I think it's fair to say. The trouble with entrepreneurialism is that they also then run from here to there, and they created a shadow banking system of enormous danger in the blink of an eye in 18 months. And so they're trying to juggle all those things. So that's change. Second change is demographics. Clearly, we're going into a period of declining workforces. Interestingly, Japan's performance, if you measure it, their GDP growth divided by the workforce has been better than the US on both sides of the GFC. Does that make sense? So in other words, we measure GDP because we want generalised growth, but if you allow for the dramatic demographic changes, that's another change. We're seeing, I think, a pushback on the fact that profits have been so high for so long. We've had 20 years of high profit share. How's that pushback manifesting itself? Essentially, the working class in America has really struggled through this whole period. I got these terrific charts I should circulate to you that show that there are 2 labour markets in the world, which is highly unusual, 2 distributions. There are about 2 billion people on this side and everybody else. And the billion people on this side only turned up 20 years ago, and they're trying to push in this direction in terms of their income. Everyone else is getting squeezed. That's a big issue. And what do we get out of that? We get Trump and Donald and Sanders, right? That is, I think, a pushback, one of the pushbacks, geopolitics, a whole bunch of other things. So these are big kind of question marks. We need to get them in perspective because there are solutions. Some of the solutions are that there are good demographic growers like India, US and so on and so forth. And I think people are starting to now focus, finally, instead of just saying central banks is the answer, we need to have a demographic solution. And that's not pensions. We seem to think about demographics like the retirees. That's not the core of the future. The core of the future is how do you create internal growth to support the whole system? And that, Merkel, I think, has really stepped in a big direction in that by saying, I'll take 1 million people to resolve my demographic problem. Germany's demographics are horrible. South Korea's is horrible. Japan's is horrible. There's a bunch of them. And the point about this is we've never done this before with a sophisticated economy, and we've never done it before with a dead economy. If it was me, what I would do is I would concentrate on immigration policy, encouraging that change. I wouldn't go negative on central bank rates because negative central bank rates, what that tells everybody in your community is that there's a problem. Every time you go to the bank, you're being reminded of deflation. Their job's to make people get their inflation expectations up, not down. They don't seem to understand this. So I'd keep them at 0 maybe, and I would concentrate on other dangers, like how do you stop a housing market from collapsing when the population's going to decline like it is in Japan, like it will in Germany and other places. So there's a whole bunch of these things. So asset allocation, look through it, have a strategic view. I think diversification is proving itself in the current environment and will continue to prove itself. Get your clients' expectations down to a lower level. Talk about your process of allocation. There will be pockets of distress. If you like contrarian fund managers and you think they're good at it, then allocate to them. I think bonds have a role to play because, and I'm on the advisory committee, but it's a stabilising asset class. A lot of people have hidden equity right through their portfolios. I mean, think about all those guys with negative gearing. It's a huge equity play, like basically. But they're now finding equity in a whole bunch of other places. People are selling so-called yielding products. If you look behind it, it's really equity. And so you need a stabiliser, but diversify. So I think you've just got to get them through that process and handhold them about volatility. It's a different world. Don't panic. Look through it. And I'm going to try this on you. Get their expectations down in returns. I did this at the OECD. I had to speak on this topic last year. And so to the audience, I go, well, get your expectations down to 6% per annum returns. This is in Europe. And you could feel the audience looking like they wanted to lynch me. So I go, well, how about 7? And then eventually I get to 8, and half the audience is going, oh, that's reasonable, right? But that's only half, and I don't know where your clients are, but if you get them down to 4, 5s and 6s, surprise them to the upside, they'll have a far more clear vision about what risk they're taking to get returns. I haven't given you specific assets, but I think funds like the Future Fund, Q Super's doing a great job on this, well-diversified portfolios. Just watch out because there will be people trying to sell you diversification in the form of unbelievable complexity. The fact is, if you're getting a 10 or 12% return, someone's doing something inside that thing, or maybe you've got a really smart contrarian guy who's now going to take a risk at the bottom of the commodity cycle. That could get you great returns, but they're really precise pockets of asset allocation. Long answer, but yeah.
Sorry, there's a question.
The Saudis put on a freeze to the oil supply that the Iranians call laughable. Is the Saudis and the Russians and the Iranians actually get together and reduce supply increase the oil price. If the rest of the Western world has low interest rates and declining growth rates, but tolerable employment rates, what will it do to the markets?
Who would you like to answer?
You're the market guy.
Oh, look, I mean, I think clearly, you know, we feel that there will be tremendous value in the oil sector at some stage. Now, that, you know, coordination hasn't really been available so far, but I guess when we go through, we believe that, I mean, I think there was a consulting report out this week saying that there's the expectation is that a third of US oil suppliers will be bankrupted in this cycle that we're coming through. And when we remove that supply, I would fully expect that OPEC can get itself together and potentially turn the tap off, and we can get quite a powerful recovery in oil prices. I guess we don't talk enough about the positive effects of having a lower oil prices, and when you go to fill up your car, it's a hell of a lot cheaper, and we should talk about, you know, some of that give back and that we'll see through the data, because it obviously comes into people's hip pockets. But in regard to your question, I think, you know, it's certainly something that markets on the lookout for. You know, we've seen oil trying to base at the moment. Certainly the price action has been more encouraging, but we keep getting, you know, a lot of volatility in and around the headlines. So look, I think it's very difficult for us to see a sustained bounce until we have removed some of the debt burden and the supply that surrounds that, at which point we would get much more constructive. I guess, the energy markets so far have been in decline, but it's been quite orderly so far, as much as it's been painful for those involved. These things tend to end with a fairly large crescendo moment, and we'll certainly be awaiting that, and then we'd be more comfortable, you know, with the investment in and around that space. Certainly for bond markets, we know that we're going to have probably a fairly deflationary scenario, certainly in Europe through the middle of the year. When we look at the way that the inflation basket is constructed, there's nothing to think that that might pick up until the fourth quarter. So in the near term, you'll probably hear more about disinflation and potentially outright deflation in places like Europe. But, you know, clearly at some point when oil does stabilise and if not rally, then that can change the construct of that basket fairly substantially as well. So it's something that we continue to monitor, and we'll do so very closely.
Post the American presidential elections in November, we started to see fiscal loss, just in deficits of US funded weight again after the agreements from a couple of years ago in box. Potentially, are we going back into a period of disagreements between Congress and the President gets in next year, and then we start seeing a replay of the US dollar crisis when they go back into the politics? We can't resolve those issues, particularly given the central banks have been doing all the heavy lifting in the last 5 years to what's happening on the business side. And also what ramifications for the bond market in the US.
I think the answer to that question is it depends importantly on who wins the presidential election. The way that districts are drawn up for the House of Representatives means it's highly likely that the Republicans will continue to control the House. Probably whoever wins the presidency will also have a stronger position in the Senate than they now do, especially if it's the Republicans win the presidency. They are likely to have control of the Senate as well. If Hillary Clinton or Bernie Sanders wins the presidency, they're probably less likely to carry Democrats into the Senate and give them a position there. So if the Republicans win, then there probably won't be the sort of conflict between the Congress and the executive of the sort that on a couple of occasions did bring the US to the brink of something when it was a Democratic president versus a Republican-controlled Congress. The only question you would have in your mind is, assuming that if the Republicans win, it's Donald Trump, how many crazy ideas are they going to agree on and then be in a position to implement? I mean, in some ways, the thought of the current crop of Republicans having the ability to do whatever they want to do is scarier than the possibility that whoever's in can't do anything, in some ways, just because they're that crazy. Now, you might say the same thing would be true if Sanders became president and had a Democratic majority in both houses, but that's a pretty unlikely sort of possibility. So if Sanders or even Clinton wins, and bearing in mind that, you know, the depth of the hatred of congressional Republicans for the Clinton family, that will influence what they do, then there's probably a greater risk of the repetition of the confrontation that we had a couple of years back. And remember that there are prominent Republicans who openly say that, you know, the trashing the currency is a price worth paying for, you know, stopping whatever evils the Democrats in their eyes want to inflict on the US political system and the world. I mean, these guys are, you know, crazy in a sense that we don't really in Australia fully comprehend. You know, some of these people who could be in positions of considerable power in the United States almost make Clive Palmer look reasonable and sensible, you know, or David Lionhelm, or, you know, whatever you want, Jackie Lambie, whatever you want to say. Maybe that's stretching it. You know, the answer to your question is, I think it sort of depends on who wins. And if we do have that kind of confrontation, then there are obviously some people in that system who are prepared to take things right to the brink. And then it becomes a question of sort of, you know, who blinks first.
Great. Well, in the interest of time, I think we'll wrap it up there. I'd like to thank the guests, Saul, Charlie, and Mike. Thought that was a fascinating discussion. My idea box is filled up again, so I appreciate that. I think Chris is going to make some closing remarks.
Thank you very much. Thank you also to the guests. Thank you to Jonathan for some excellent questions. More importantly, thank you to the guests for their excellent and informative answers. I'd also like to thank Deloitte's Declan O'Callaghan, who is the partner with whom we I was going to say Declan, actually we organised it. We actually organised it with Heather, his fantastic PA. So thank you to Deloitte's for their facilities today, and thank you to Heather for all your hard work. Thank you. And thank you to you for coming.